I want to welcome everyone to the Zacks Quarterly Market Strategy Conference call. It's a service of Zacks Professional Services Division. For any first-time attendees, this is a live conference call that features Zacks strategists providing their analysis of the latest issues and trends affecting investors, the market, the economy, both globally and here in the United States. Joining us today as panelists, we welcome back Tim Nyland, Managing Director of Zacks Professional Services, and Zacks Chief Equity Strategist and Economist, John Blank. This is our end of the year look back, look ahead call. Tim is going to be sharing his thoughts on events that have brought stocks in the market right up to where they are today, and then John will take over and look ahead and share his outlook for the new year. So if you have any questions for either of these two gentlemen, all you need to do is type them in the message field at the right of your screen, and we will get to as many of them as we have time for. So Tim, we're going to start with you. You have the look back portion of the call. How far back are you looking?
Yeah, thank you, Terry. Appreciate that. So we're going to take a look back at that sell-off that took place about a year ago, the Q4 2018 sell-off, and we're just going to do a quick post-mortem. I've got a nice slide deck of 30 slides or so that illustrate some of the ZRS and advisor tools, the Zacks advisor tools charting capabilities. And so we're going to start out looking at the S&P 500, specifically the market-weighted composite proxy that we support. And obviously there's many reasons for this I don't have time to get into on the call, but it is a superior valuation tool relative to the reported benchmarks. And so we're going to look at the Q4 2018 sell-off relative to price performance in 2019 year to date, and then take a look at the Q4 operating earnings growth as well. And you can kind of get a preview of where I'm going with this. And this is something that many people don't have a chance to see in this particular light. We can see the sell-off took place here. Price is obviously in blue. Your trailing 4 quarters adjusted earnings line here in orange. And you can see that we've had just this precipitous multiple expansion. So the distance between this price line and this flat earnings line in 2019 continuing to expand. So that's really going to be the theme. What we're looking at again is a 20-year chart, and I'll be dialing this back to a 10-year chart to get a little more granular here in just a couple slides. But as I move forward to the next slide, again, I just want everybody to note that since that Q4 2018 sell-off, we've had an extreme multiple expansion, both trailing and on year-forward EPS. And again, you can see the sell-off here. And as this blue line, the price line, running away from this flat operating earnings line. Next slide. And if we take a look at this in terms of valuation, which is obviously the preferred method, you can actually see this sell-off that took place in 2018, specifically in Q4, brought us to a PE that actually dipped below a 15 handle on year-forward EPS. Since then, we've actually rallied back to greater than 18 times forward earnings. This chart also shows the accuracy of the composite methodology that we utilize relative to the reported index providers. If we go back to the original price and earnings chart that we did and we dial it back 10 years, you can see the multiple expansion more clearly that we've had on basically zero or flat earnings per share growth. Now what we're going to do is we're going to bump through all 11 sectors fairly quickly, and you'll see a similar trend. We're going to actually start shifting our focus to the 2020 EPS growth and beyond. And if we do that right now for the S&P 500, you'll see a trend as we go through these slides that the buy-side community was very, very pessimistic here, obviously, in Q4 about the likelihood of perhaps this turning into a downturn. And you can see that very, very quickly, come around January 1 or so, the buy-side turned on its sentiment and said relative that these earnings are in fact going to recover in 2020. And you'll see this theme carried through each of the sectors. So we'll start with the consumer discretionary sector. You can see that we've had, in terms of percent change in the forecast for 2019, that's this year end, relative to where we were on a trailing 4-quarter EPS adjusted number as of December 2018 is 407, is virtually flat. It's a little bit up, but not much. Same thing with staples, although you can see the staples multiple expansion really taken off. And again, what's going on here is that the buy-side community is looking through this flat period of growth in 2019, saying that there's going to be an earnings growth story returning in 2020, and that story is likely going to play out for some time. Again, we can see this here through communication services as well. Multiple expansion on a recovery in earnings that has not yet started yet. Mark, is that your PC that just launched Zacks Research System? Apologies for the technical difficulty. Mark, go ahead and let it load first, and then we'll just... Okay, let's try that. Here you can see what a real earnings recession looks like, in this case, the energy sector. And what's really interesting to note here from an analytical perspective is even though we've got earnings down 30% in 2019, we've actually had a multiple expansion because the price hasn't fallen as much as earnings are expected to. And we have a rebound taking place in 2020. So from a trailing EPS perspective into the next quarter's forecast, we actually have a multiple expansion. And then obviously, to the extent these earnings do rebound, we would expect this energy sector to pick back up. Here you can see some real cyclicality. Financials are one bright spot. We actually have a positive EPS growth trajectory throughout 2019, despite the yield curve. And again, we have multiple expansion here as of late second half 2019. You can see the price line running away from the earnings line. Healthcare, another bright spot, 10% EPS growth across 2019, and as of late, a real nice multiple expansion for healthcare. Even despite the fact that healthcare looks like it may go a little bit flat in 2020, there is some excitement here in the healthcare sector. Industrials, that multiple expansion has been creeping up in anticipation of obviously geopolitical events, tariffs and other things. You can see this 2020 earnings recovery here forecast to take place. And that would be in light of a 2% decline overall in industrial earnings in 2019. IT, this is one that's been touted as being fairly overheated. This ZRS chart that I'm showing you illustrates that very well. You can see tremendous multiple expansion on an actual decline in earnings of around 2% in aggregate for this space. And again, a modest recovery in store. It appears as though a recovery for 2020 and beyond is already fully baked into the technology sector. So as we're going through these sectors, that's what you're going to want to pay attention to, is how much more room is left to run for some of these who already have recoveries fully baked in for the next year. This slide deck will be made available to everyone. You would just send an email and ask to receive it, and we will go ahead and send it out to you so you can have these charts for reference. The materials sector, similar to what we saw in the energy patch. Again, a multiple expansion as of late. Already the buy side is pricing through this downturn, looking year forward out here, saying that we're going to get a recovery, and we have seen a positive response in the materials sector. A classic cyclical story, a classic cyclical sector. 2019 earnings down 36%. Okay. Real estate flat on earnings, however, nice multiple expansion. Obviously, great yield in this space relative to interest rates that have been on the decline has helped push that multiple expansion forward, which we see here. Utility sector, same exact thing. We've actually had an increase in growth, but as those interest rates coming down, that nice yield on those utilities in 2019 has triggered a nice multiple expansion in that space. Okay. So what I've just shown is some significant excitement across the buy side in terms of their willingness to bid up PE multiples in anticipation of this earnings recovery that's expected to take place in 2020. I would say that it's done so much as to fully price that in at this point. What's going to be interesting now is to just very quickly take a look at some of the signals that the credit market is sending us. And I always like to try to do things a little bit differently than what you would see traditionally on CNBC or read in the Wall Street Journal. So I've pulled together one of my favorite charts for looking at recession indicators over a long-term trend. And that is actually not looking at the Treasury yield inversion that everybody talks about in terms of the 10-2. What I like to do is I like to actually look at how the 2-year rises to meet the 10 prior to each of these recessionary periods. And you can, trace this back through time. It's a really, really nice indicator. The next slide I have here to show you illustrates this case in point, with the recessions normally taking place a year or two after this happens. And it is interesting to note that we do run into periods where this indicator doesn't necessarily pan out to a recession. It just depends upon how responsive the Fed is and how the consumer stays afloat. We can see that back here in 93, 94. We had an indicator. We had the 2-year rise to meet the 10, and we had no recession. But that indicator then repeated itself here, and then the recession took hold. Same thing here. Same thing has happened here. But again, this could be another case where it could be different. We've got global economies whose central banks have literally flushed, the markets flush with liquidity, and we have a really, really strong consumer across the board. So it looks as though the accommodative Fed and everything else is really going to help maybe alleviate some of the pain that we would have otherwise anticipated experiencing here as soon as 2020. But just keep your eyes on this chart. This is an advisor tools chart that I pulled up. I really like the way it graphs. But you want to just do a long-term trend, look for the 2-year rising to meet the 10, and then throw up your recession shading, and you can see that. For any advisor tools users on the call, we have a new release that'll be coming out that's going to feature a lot of these charts. I built out a new economic library for these types of views, so you'll have those in there as default. What I want to do is I want to shift back to equities now very quickly and talk about some of the core portfolios that are in both the Zacks research system and the advisor tools system, and how to use these just very briefly in anticipation for a future call that I'm going to be hosting in late January, early February that I'd like to see everybody attend. It'll be a really, really good session. And I'll speak more about that here in just a minute. You can see this particular chart here is the core industrial portfolio. So this is a clean portfolio of 400 industrial names with none of the tilt sectors present. And what I call a tilt sector, these are very unique. It's literally a sector whose underlying members all behave the exact same way with regard to changes in interest rates. So you could almost say if you own one financial, you can pretty much own them all. You own one energy company, you can, broadly speaking, you could say that group pretty much behaves the same. Same thing with commodities, precious metals, and utilities. So what we do is we take the S&P 500, we strip all those tilt sectors off. You're left with about 250 names. We throw back in 150 names to get to 400. And then of those 400, I'll actually split based on earnings stability, that group in between 200 growth names and 200 cyclical names. And we do this as a valuation proxy. It gives us a really, really clean idea for what we can truly expect to take place in 2020. And you can see that this chart looks eerily similar to the S&P 500 composite chart that we put up, except for the core pulse of the U.S. economy, which is what I call this core industrial portfolio of growth stocks. You can see that we actually have continued growth here in earnings through 2019. So this is going to be the 200 growth companies from the Zacks Standard Industrial portfolio that are most earnings stable. That trend is expected to continue. Okay, so this is a solid core industrial growth portfolio, and you can see how it performs right through recessions fairly well. The Zacks cyclical portfolio is probably the best pulse of the U.S. economy out there. First of all, to have a portfolio of 200 cyclical names at your disposal is key, because in a lot of cases, you know, Goldman and a lot of the other top firms will try to call economic cycles, and you'll be scrambling trying to figure out what, you know, these cyclical names are. We have these available for you in both ZRS and Advisor Tools. This is 200 companies that are tied directly to the U.S. economic cycle, and these come right out of the Zacks Standard Industrial Portfolio. Again, there's no tilt sectors present, so these are true industrial companies. What I want everyone to see is the story remains the same. This is how you validate what you're seeing in the reported benchmarks and your own custom benchmarks that you create. You look for these trends. Again, we have that multiple expansion. We have price that's actually increasing against a backdrop of an earnings recession. So what this is telling us is that because this Q4 period is not over yet and we're still in the forecast period before the earnings recovery hasn't started yet. And the buy side actually started buying cyclical stocks back on Jan 1 in anticipation of the recovery that was expected to take place 1 year from that period. And you can see those forecast points out here to the right, okay? So right now in the cyclical group, the forecast is in for a full recovery, and we have had a massive, massive PE multiple expansion in anticipation of that recovery, okay? Now, when I watch CNBC, and I have it on the background pretty much all day, every day when I'm working, and I read the Wall Street Journal, I see things like this. Sometimes I want to throw my shoe at the TV, other times not. But in this particular case, this was a Goldman Sachs article that was put out back on July 25th, 2019. It says Goldman sees stronger second half growth, says to buy cyclical companies. You know, it's funny because that train really left the station 7 months prior. The buy side was all over this right around the 1st of January. So this is where I say the train more or less left the station here. The Goldman article came out here. So multiple expansion, again, has already baked in a full recovery in year forward earnings. And you can see that really, really nicely here. Here's your 2020 EPS line and 2021. So if this trajectory does in fact continue, there's definitely more upside here. Not saying the Goldman article wasn't correct. It's just that this has been going on for quite some time, probably the 7 months prior, not just effective then. Interestingly enough, just last week I heard another prominent buy-side firm on Wall Street issue the same, time to buy, or the same call to buy cyclical stocks. So just, a word to the wise, be careful. This is what the valuation looks like for the cyclical names. You can see that we're currently trading on a forward earnings basis at 16 times. The median is at 15, so a little bit above median. And this is a post-recession view of the PE for the cyclical proxy, what I call the cyclical portfolio. So a 10-year view. Notice that the high is 17.3. So we've almost baked in a full recovery of that group based on 2020 earnings growth on the forward multiple. Okay. So the idea is it possible to recession-proof your portfolio's earnings stream? The whole theme with the Q4 sell-off was the recession is coming, and boy, did we feel the pain. And that was one heck of a sell-off. And it was nice to see that sentiment turned so quickly. But my question for everybody on the phone is, what happens when we finally do get that shot across the bow and sentiment doesn't recover? This is really where the rubber hits the road for the advisors. The downside protection of your client's wealth is key. And we have a portfolio that what I call is more or less recession-proof with regard to the underlying earnings of the companies within this particular group of stocks. So this is what we call our earnings certain portfolio. It's basically 75 of the most earnings stable names from the Zacks growth portfolio. So this is a core portfolio designed to be used as your core equity holdings. And again, there are no tilt sectors present. There are no financials, no energies, no commodities, no precious metals, no utilities in here. So it gives you the ability to apply all of your sector tilts There are also no, high-flying.com names in here, no IPOs. There's no pot stocks in here. These are all very boring, extremely boring, well-known household names that literally just continue to perform quarter after quarter, regardless of what happens in the underlying economy. When combined as a dollar-weighted portfolio, provide a recession-proof backdrop for your earnings. When we look at this from a performance perspective, and this is a 25-year chart of performance, you can see where we really begin to pick up alpha is in those recession periods. You can see the S&P 500 relative to the earnings certain portfolio. And you can see that we just continue to march right through recessions. And here we did have an issue with a sell-off, but it was nowhere near as deep, and it recovered much quicker than that of the S&P 500. And you can see the annual total return differential here, 15.4, almost 2 times the annual return of the S&P, clocking in at about 985. So again, this is a model portfolio. These are hypothetical returns for illustration here on this particular presentation. But it does translate to a cumulative composite return over that 25-year time frame of 3,600% relative to about 1,000%. And again, everybody on the call knows what it takes to recover from this type of a drawdown. And the earnings certain proxy just didn't have that severe of a drawdown, and it really never does. Again, boring names. Not even Apple is in this group, so you can even tilt on companies like Apple to provide extra alpha. So I've been managing these core portfolios for over 25 years. I think that going forward, as an advisor, this needs to be something that you're at least thinking about as to how to provide more downside protection for your clients on your equity portfolio side, just given the fact that all these different asset classes have become so correlated over the years. This should be kind of music to your ears or a breath of fresh air. In January, February, I'm going to be hosting a webinar that's completely dedicated to the core portfolios. I'm going to talk about the original intent of the portfolios. Some of you will be shocked as to how this actually came about. Talk about the construction process of each, talk about how we actually distill the earnings certain portfolio out of the core portfolios. There's almost zero turnover in these groups, specifically the earnings certain portfolio. And we'll go through all the details here. So stay tuned for that webinar. And in the meantime, if you're interested in talking about anything that I've spoken about today, here's my contact information. Feel free to reach out to me.
Tim, I just wanted to follow up on a couple of points. You talked about the 2020 earnings rebound that is on the horizon, but why do you think these earnings recession that you talk about has not morphed into an economic recession yet?
That's a good question. So there's probably 3 reasons why. We've had a really accommodative Fed, and that was one of the things that concerned me late last year is, we were going through a rate increase cycle, and we really needed to stop that. And in fact, the Fed did respond. So we've had an accommodative Fed. We've also had global central banks continuing to, just keep the global markets flush with liquidity. That's definitely helped. And then we have just consumers that just refuse to stop spending. So it's really, really consumer driven at this point. The consumer's just on fire with the job rates and everything else with unemployment. So those would probably be my top 3 off the top of my head, Terry.
All right, and aside from the earnings certain portfolio that you highlighted, is there anything else you think investors should be doing now to try to recession-proof their portfolios?
Yeah, diversification is key. Never feel bad about, taking a little bit off the table in terms of going to cash during these really, really uncertain times. I would say now we're more in a recovery mode than anything, but, Q4 last year was definitely scary. I know I raised cash, and I did it at the end of 15 as well. And again, work with us. It is possible to see this stuff coming ahead of time. But you definitely want to just remain diversified and really try to think about how you can, more recession-proof your core equity holdings at this point, just given the fact that we're, so far down the road or down the path in this economic cycle. It can continue, but it could also end at any time. So.
Okay, thanks for that. Points all well taken. Now we turn to John Blank, our Chief Equity Strategist and Economist. John, you're going to help us take a little bit of a look ahead into the new year, huh?
That's right, Terry. First of all, thanks, Tim. I'm not going to find myself to be in disagreement with Tim more than I am to be in agreement. One of the things that came to light in Tim's portfolio analysis that I agree with and want to highlight before I move along is incredibly strong valuation lift to consumer staples, real estate, and then the huge valuation expansion of utilities. All of that is the evidence of central bank quantitative easing, buying out the bonds, putting cash in banks and in fixed income firms and forcing them into interest rate yielding securities. And you're seeing the QE mostly in that really smooth rise in the valuation expansion. When it's really incremental and really smooth like that, you can assume some huge macroeconomic force is doing it. And that is the central banks of the world. And Tim was correct to point out, it's not only the Fed, it is the central banks of the world. We had more easing last year out of 90, we had like 90 rate hike decreases across 45 central banks, the most since 2008. And the Fed had basically their hand forced. They had to do what they had to do. So the other thing I'm in agreement with Tim on is this recession can come at any time. I'm sure you all saw the Wall Street forecasts for next year, 2020, laying out this story that it's basically a 5% returns year going forward. I'm not going to actually contradict that, but what I want to point out to you today, really more than anything, is vigilance from now on out. And you have to start to think at least monthly and no less than quarterly at going into certain macroeconomic services, valuation services like this. And the thing I'm going to show you today, that the Chief Investment Officer survey at Zacks, which I put up quarterly, and just stay on top of it. Because no one's going to call this turn a year in advance. But quarter to quarter, month to month, you can do a good job of being more vigilant and more on top of the way things are going. And that's my basic advice here is start to be vigilant. Get regular in your assessments. Do this not every week, but once a month or once a quarter, and just say, okay, are we any different now? And so that's all I do with the Chief Investment Officer survey I'm going to show you today. There's 12 questions, and I'm going to go through them and then give you my color and my thoughts on whether I agree with these groups. But you need to understand when you're looking at these charts, you're looking at 10 to 12 very senior portfolio managers with hundreds of millions of dollars in investment under their guidance, and that they have a forward look 12 months ahead on what I'm looking at. So this is more investment manager stuff than trading stuff. And it is also just, you can see as you look across the distributions of opinions, like I have right now, the large cap returns for next year, that there's actually a fairly wide range of views next year, right? There are ranges of views from basically nothing, which is the median. People are not very bullish next year, to seeing some returns, right? I mean, you have some people who actually do have 15% returns next year. So the point of this survey that's really nice is you see the distribution. Right now, what the distribution is showing you is there's not a lot of real solid belief out there, other than this is a very fully valued market, which Tim already pointed out to you. And likely we go sideways just because the valuations have already caught up with whatever earnings we do get. Let's go to the next slide. Mid caps. Interestingly enough, $1 to $5 billion market cap stocks might be the sweet spot next year. Do I like that? Do I agree with that? Actually, I do. I think the thing you want to think about here is less than $1 billion, these companies, a lot of them make no money. A lot of the IPO markets are 80% of IPOs are making no money. There's a lot of companies in there that are junk. And they add a lot of jobs, they're good stories, but they haven't really gotten business models to profitability, and they haven't got scalability in play. So there might be a little zone here in the 1 to 5 billion market caps where the names are not as well known, but the companies are actually in decent sized footprints in their markets with a decent portfolio of product offerings. This might be the area next year that you can pick up a little more return than just basically a large cap stock portfolio. Let's go to the next one. Small caps, again, a little less than large caps. I think that's true, or mid caps. I think that's basically true. Again, you've got the growth story. As long as it holds up, these guys will do fine. I'll flip that around though. If we get any sense of a downturn, these guys are going to get hammered. So I'm a little skeptical of this call here because there's a lot of junk in these names. There's a lot of financials in these names, and they're going to get hammered if there's any downturn. So I personally wouldn't. I took my overweight on small caps down to market weight the other month, and I doubt I'd go back up again because I just don't see this happening. I mean, anything can happen, but it's not likely. Next one. Large cap growth or value. Growth may underperform. That's right, you saw it. Growth may underperform. Doesn't mean it's not going to make you money. It just means that a lot of these growth stocks are so bid up. I saw the other Ubiquity Networks I put out a piece on. Forward PE ratio of 36. Now, I think Ubiquity Networks in their business, great product, great idea, but not of a 36 PE. So again, the basic idea is valuation's gotten way out of control for a lot of these tech stocks, and they may underperform. And the underperformance may be nothing more than, another point Tim pointed out, which I agree with, is people raising cash. So you got Ubiquity Networks and 90% return. You're a portfolio manager, you lock it in. That's going to take Ubiquity Networks down 20% because everyone's going to lock in profits on Ubiquity. So the point is, large cap growth may underperform in the face of a recession, and in the face of a huge valuation expansion. Just get that profit off the table, put it into cash. Next one. Mid cap and small cap, very little difference. Here, value and growth, there's not a lot of, they're pretty agnostic. You can see that in general, they're basically thinking there's no real value to splitting the value and growth stocks up in mid cap and small caps. Just the idea. Next one. All right, sector plays. Interesting, infotech and healthcare. Those are the obvious, names that where the earnings growth is. I find financials and energy to be interesting to be here. Do I agree with either of those calls? Energy, after the OPEC meetings, where the Saudis took such a big production cut, and seeing the incremental build out of the WTI oil price over the last 6 or 8 months, it's an interesting call. If it's me, I like infotech and healthcare. I have trouble with financials and energy because of what Tim pointed out with the earnings certain portfolio. These guys can get hammered. So why bother? If I got 4 choices, I'll take the 2 of the 4 that are better for me and go over there. So that's just me, but generally speaking, some of these plays, the reason people like financials and energy in these spaces, they're very low PE multiples. So what they're saying here is if you like value stocks, you're going to buy financials and energy, and maybe there's going to be a rotation into these less risky names, people taking profits out of the ubiquities and putting them into financials and energy. That's basically why they're overweight in those stocks. Next one. Global regions, emerging Asia and Latin America bouncing back. This is basically the call is, I think it's right. You get some settling down of the politics in Latin America. You get some of the buying out of China, and you get some of the dispersion of trade, whether there's a deal or not, out of China to the rest of Asia. And so this call really isn't about a trade deal per se, as much as it is about China positioning itself to win no matter what. And if it does that, it's going to keep its costs down by moving production into emerging Asia, a trend that's been happening for 10 or 15 years anyways. And they're going to start to buy and support more of Latin America. So this call is basically that idea that the Chinese are going to ride this thing out and it's incrementally positive for you if there's a trade deal, and if there's not, it's still positive. And that is the message here, is that the Chinese have come up with we win or we win, right? Heads I win, tails you lose. So the Chinese are not dumb. They're not going to run the economy on an either or fashion. They're going to run it to make sure they win no matter what. Next one. Okay, lots of CIOs do not have opinions on country ETFs, which is understandable. That's the purple line. They don't follow these as closely as they can or could. The only thing that's interesting is to kind of disaggregate some of the names out from, and look at again, and again, you see Russia, China, Australia, Canada, Mexico. And this is the point that I made just a second ago, is China probably gets a cyclical lift because of the expansion. They're going to keep that in place, trade deal or not. They've been stimulating for a good year now. That'll take up Australia and Canada. And Mexico and Russia, you basically have situations where those economies can turn around or be seen as alternative suppliers to either China or Europe or to the United States. So you can see here, the United States is certainly going to be fine because Mexico and Canada are on the list, and also China probably will be okay. Next one. Okay, rates. The one thing I want to point out here more than any is the Fed funds rate. And what you can see here is, I think our legend got a little screwed up. The yellow, the bright yellow line is 50 to 100 basis points of easing. So we are at 1.6, 1.7. So the fact that this group thinks 50 to 100 basis points of easing 12 months from now versus probably 1.6-ish now, this group is looking for 2 rate cuts over the next 12 months. The Fed fund futures are looking for at least 1. So the basic difference between what you heard from the Fed yesterday and the chief investment officers is the chief investment officers are much more concerned that the way you're going to get a lift out of this market is even more cuts than the market thinks, and certainly more than the Fed thinks. So this is a group of people who are betting on as many as 3 more 25 basis rate cuts over the next year. That's that yellow line. And by the way, that's half of them. That's a lot. So again, distribution-wise, there's a very convincing story out there that this easing cycle has got a longer ways to go, and this pause we're in isn't going to be very long. And that's not the consensus out there in the market. That's the consensus of people who are managing longer-term funds. Let's go to the next one. High yield spreads, blowout, right? All you need to see here is that expand in the high yield. I think the issue here is way deep in the high yields, down in the C's. Not the double B's and the B's, but the C's. There has been a lot of concern about the C's. There's a lot of junk that's probably piling up. And the first thing to get hammered will be the junk. So you do want to stay away from really badly rated high yield and differentiate that from your double B's, which are probably going to get bid up in the same way that QE works. It's basically stay away from the junk and buy the quality. And as you can see, taking it all the way into the investment grade space, things are probably going to hold up pretty well for the corporate space. Next one. All right, bearish on gold. Unis look okay. Market perform on oil and commodities. So here again, I think the market perform on oil and commodities I'm really with. I don't see much of a play here. Haven't for years. And I really don't think anything other than management out of the WTI oil price coming from OPEC. They don't like big surges and they don't like big collapses. So they could probably keep this thing, 58 to 60-ish for the next year on WTI. And gold is bearish. I think that's basically saying, you get some relationship with oil, and basically people are saying gold got way overbought by the central banks over the last year, and there's probably not as much demand to be had out of gold. Myself, I'm still fairly bullish on gold. I think with the amount of liquidity out there and the rising in the oil price out of the production cuts, I mean, the Saudis, news groups, they like to benchmark some of the cash they make out of oil in an asset allocation model that benchmarks to gold. So gold tends to get a bid when oil prices are pretty good. So I'm a little reluctant to be bearish on gold. I just think it's more a call that they're going to take profits off the rise that's already taken place here. That's bearish here in that context, much like earlier about the large caps not performing well, is basically about people taking profits. And I think that's how you should read that. So let's go to the next one. All right, so I'm going to finish up today with macroeconomics. And of course, the one slide we all like to look at, and I put it up for you, is this unemployment rate. The black line is the natural unemployment rate, which is about 4.5% now. And we're down at 3.5%. And you can see that this is, typically a very low unemployment rate relative to its natural unemployment rate. The thing I'll point out to you in most of the scenarios, as Tim pointed out earlier, we're certainly in a scenario where recession's in play. However, look back at all the other recessions, and when you get to a recession, it's almost never the case that you see a U-shaped unemployment rate. It goes flat for a year or two. And BCA analysis and my own analysis, just looking at this chart, tells you that, and I looked into the unemployment claims, weekly unemployment claims, we've been tracking flat for 12 to 15 months. And this doesn't get picked up on this particular unemployment rate. So somewhere between now and literally next quarter to 2 years from now, we're in a high probability zone here. But that means we got as much as 2 years of sideways tracking of unemployment. You can see that in the 60s, how long it took. It took a long time with a little dip down, a little bit run back. Look at the 80s, took a spike down, then it kind of waffled around. The one time that kind of looks V-shaped is the tech area. We all know that story. There was too many tech firms, they blew up. And then the housing thing. That was largely a creation of the financial world making some incredibly fraudulent bets on mortgages that nobody saw until too late. Now we're in this zone. And with all its excessive PEs, utilities, real estate, and consumer staples, at the end of the day, they are what they are. They're very safe companies that are overbid by 15 or 20%. Very unlikely that that causes this type of thing. Much more likely we need much more fraud or much more excess than this. So I think your better call right now is waffling around. And that is the CIO call with zero returns for stocks or some return out of mid caps. You're going to look out for the bomb to drop in the C-rated stuff and high yield, and then basically waffle around. And waffling around should be your base case for the next year. That basically nothing happens with the unemployment rate, and therefore nothing happens to the economy. That's your base case. I'd put that at 50%. Next slide. Okay, the other thing I want to point out, though, this is the labor force participation rate across cycles. And you can see, first thing to notice is it used to be 56, 57% in the 50s, and rose all the way to 67%. Who was that? Our women. Women entered the labor force. So a lot of the growth that you see, 3% growth rates in the United States, all the productivity gains, really what that was the dual income household emerging out of World War II and peaking at the tech bubble. And since the tech bubble, 5% drop in labor force participation, which means there's actually been a shrinking pool of workers out there. More women are staying home as they have children. And this is basically the idea that it's half of what we gained from the 50s has been reeled back, and more people are just staying out of the workforce. And it particularly took a dive after the 08 crisis. You can see we went from 66 to 62. That's 4.5 points. Now remember, we have a 3.5% unemployment rate, but it's based on a internal move that is not telling you what this chart's telling you, which is there's been a 4.5% move in labor force participation. People are simply not coming back. And if you look at how it's coming up from 14 to now, it did rise. It is rising very imperceptibly, but not much. 62.5 to 63.2. That's people entering and moving it up. But as you can see, we've never unreeled a lot of those people who left forever. And that's what I'm going to get to in my next slide. Let's go to the next one. People are starting to understand something changed. Every cycle, saying an unemployment rate's X versus the 60s or the 80s. What were these people doing today versus the 60s? There was no infotech, right? None of these companies existed. So we're still valuing the unemployment rate across decades of time without really thinking about what has changed. So if you factor back what some Richmond Fed economists did, the amount of gig economy part-timers, the amount of people doing jobs they really don't like, they're doing because they need the money, and various other things, you end up with the blue or black line. And you can see, yeah, we've done a phenomenal job of creating jobs this cycle. And a lot of them are crummy, right? They're crummy gig economy jobs, low benefits, a lot of stuff like that. Just to give you one anecdote out of my own life, I went to a beach volleyball game the other day, 30-something kid. Said, hey, I work in your neighborhood. I got 3 jobs. And he said, I got plenty of ability to find 20 hours of work anywhere I want. I just piece them together. And he thought that was great. That's what this chart's telling you. He's got 2 jobs. He's probably underemployed, even though he's making the same. He's going to factor as an employed person. He doesn't have a lot of benefits. And it's probably a less quality of life than a full-time job. And this is what's happened. We've got a lot less of this than you think. For example, take the blue line, 7.3% versus the 3.5%. It shouldn't surprise you that some of that is the labor force participation rate. That's the same differential. And it's basically the same unemployment rate we saw at the tech bubble, right? So it's not better, right? Let's go to the next one. And the next, Cornell did a study on the same thing, looking back to 1990. They say job quality has declined 15%. So one of the things we're struggling with is growth, the lack of inflation, consumer price inflation, the lack of wage growth. What you're seeing here is that the infotech boom and the way the globalization worked and all a medley of other things, including social issues, family dissolution or reconstruction, all these things of aging, people leaving the workforce for retirement purposes, creating other jobs. If you net all that out, this is a crummier labor market quality than we've had in the last 30 years. That's why this is likely to stagger on too, because frankly, the 3.5 is overstating things. We still have a lot of quality adjusted issues in this economy that are not being accounted for in macroeconomic data. So let's go to the next slide. All right, so basic scenario as the traders think 1 or 2 Fed rate cuts versus the CIOs, they agree on this, and that's going to keep the bid on stocks because there's simply going to be the case, as I point out, of a supermarket where you go into a supermarket to shop and the Fed bought half of everything in the store. So if you go to a store and there's half as many goods as you thought there were going to be, you're going to have to fight with everybody else with what's left. And that's what's happening with stocks. People are just buying up what they got left, and the inventory is being warehoused in the Fed or the other central banks of the world. And they're going to keep the easing cycle going for another year or so. That's the consensus. Again, 50%, not 100, but that's where you should be. Next slide. Okay, this is the big elephant in the room. Tim brought it up. Everybody talks about it. We all know this is correlating with the valuation lift, the stock prices, and all the rest. It's the central bank balance sheets. When we started this game back in 2008-ish, you netted all these out at about 7 trillion. Now it's 21 trillion, tripling. We tripled the balance sheets of the world's central banks that matter. Let's say that again. Just think it through. Let it sink in. We have tripled the balance sheets of the central banks of the world. Unbelievable, right? And we all know this is the force more than earnings or anything else, because it gets back to my basic analogy of the store. If $14 trillion of bonds and mortgage backs and repos and all this stuff, including ETFs in Japan, corporate bonds, 14 trillion is warehoused. That's the size, 70% the size of the US economy as it exists today. Phenomenal. So, and also very closely examination shows that we tried to back this thing out in that period in 2018. That did cause the deflation that Tim talked about. And now we're basically ending that, right? That whole experience of trying to unwind this is going to be very difficult. And let's just leave this here and think about this. I told you quality of labor jobs are down. We know growth is weak. Inequality in the world is rising. And so what's happened is all the banks, central banks of the world are really the effect, not the cause here. I mean, what has happened on the fiscal side of treasuries around the world is they have none of this growth. They try to supply it. They run deficits. There's so many deficits out there. China is one of them, building all different in their gambits and their plays and their strategies. But the basic point is everybody's struggling with inequality, poor jobs, and low growth. So the governments stimulate, and we never see the inflation because whatever period of the world's in, we just don't have enough growth. So the deficits don't seem to matter. And then we've got this final effect, which is the QE has also had a second effect beyond share price increases, which is the central banks of the world are warehousing all of the debt that's been created over the last 15 years of globalization, right? And this is something that gets some people very alarmed about. But at the end of the day, it's paying Peter to pay Paul. The Treasury issues, the central bank buys them back and warehouses them. And as long as there's no real huge imbalance created by inflation, because we don't have the growth, it seems to be a fairly effective way. And I seriously doubt we ever do anything but continue to warehouse more debt through this period of globalization until we see some type of change in the inequality and some type of rise in the job qualities out there. And I think this process is irregular enough and extensive enough that it's not going to happen anytime soon. So the other thing to think about is all what really is happening here is we're learning to warehouse our deficits from treasuries and central banks, and that's basically paying ourselves off. And that's not the same as a company in terms of debt. It's not as threatening because you can just basically have a debit and credit between treasuries and central banks. It's going on everywhere in the world because everybody's trying to struggle with not enough growth, and they're not having to face the consequences of it because no one has the hyperinflations or even 5%, 10% inflations that would start to scare the financial markets. So let's go to the next slide, but keep this in mind. All right, zero rates, negative rates. Let's go one more slide, and I'll stop at this one, which is let's go one line. There it is, negative rates. I don't think these things should be worried about. All these things are really marking is you can't leave money at central banks without paying a fee in terms of a negative rate. So if you're a bank, you can't park money at the Fed, the BOJ, Denmark, ECB. They're going to charge you. So what do? You put it on your own balance sheet. Now, the trick here is, you say, oh, that's terrible, we can't charge negative rates. Sure we can. Banks charge you fees for all kinds of stuff. You got ATM fees. They charge you for your money just to get your money, right? We all know this game. So if they're doing this, you're going to keep away from it. And it does create some growth, because then you have to have financial performance measures in private banks that look crummy because you're carrying more cash, and so you start to lend it out to improve your financial ratios. So the idea is to push people to make more money in the actual real economy by doing this. And there actually is some evidence that this works on the margin. But for all of us and for all of you, remember that stocks and bonds and QE is the supermarket. This thing here is into loans, and loans aren't as much of an issue anymore for stocks. It's in the fundamentals, yes. It does drive growth incrementally, but it's not going to make a big move. Your real issue is stocks and bonds, not loans, and loans is really what the negative rates are all about. So with that, I'll finish up, but my point today is hopefully you realize what we're really in, as Tim pointed out, is using tools like ZRS and the CIO survey and other things. Stay on top of this. There is no answer to when this recession comes. To some degree, it's circular because we're all going to create the sentiment of whether it happens or not. And my basic point for you is to have meetings month or quarter. No quicker. Don't get overweight on this thing. Let some time pass. But use these tools and get used to having this discussion in a regular place and making the calls, and so you can have your own sense that yes, now things really are different and we really do need to make some changes. With that, Terry, that's it for me.
All right, John, thanks. I want to call everybody's attention to the fact that CIO survey is up on the ZRS platform. I believe you can access it through the market strategy menu. And with that, we're bumping up against time. In fact, we are over time. We'll have to wrap things up for another call. I want to thank our panelists, Tim Nyland, John Blank. Hope you found this informative as far as the listeners are concerned. And if you have any questions regarding the services here, just feel free to email them to zrs@zacks.com. Likewise, if you would like copies of Tim or John's PowerPoint presentations featured in today's call, again, email zrs@zacks.com. Contact your ZRS representative directly, or you can even access them in the GoToWebinar console. And we want to thank you for joining us. As always, feedback always welcome. In fact, after you close out this webinar, you'd be prompted to fill out about a 1-minute survey. We would appreciate it if you would take the time to fill it out, because we do pay attention to those comments and use them to improve the quality and content for future calls. Meantime, we hope that you have a happy holiday season and a prosperous new year, and we'll look forward to the next time we're all together on the call.